Okay, everyone, let's get started. This is Steve Lentz. I'm with Discover Options, the educational arm of OptionVue Systems International. Welcome to our mentor series. We have a fantastic staff here at OptionVue working on our Discover Options mentoring. We provide one-on-one mentoring services for advanced options trading. And today, I'm just going to go over an approach to charting the markets called point and figure. We'll go over the mechanics of that, and then we're going to look at a system of trading. And we'll just take we're going to take a look at some breakouts and see how that goes. But let me switch over here. Let me see. I'm over here. Okay, there we go. Today is June 10th, 2013. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So we have a real interesting presentation here today because this is a way of charting that goes way back. Now here I was showing you, the point and figure, okay, point and figure charting, okay, and we're talking here in this title about top and bottom, triple top and triple bottom breakouts. And those are kind of and we're going to look at using credit spreads to do this. But sometimes when you look at a chart, the price action can get kind of messy, and you know that there's been some big moves here, and this is going way back to, oh gosh, the tech implosion back in 2000, 2001. And I'm going to use more current charts and show you some stuff here in just a little bit. But if you're looking at this chart and you're trying to pick a good place where you could have gotten in at the top, where there was a breakout coming down, you would have looked somewhere up here, and to cut through all the noise, okay, there I blew it up a little bit, and if you're going to cut through all the noise, you could have looked at you could have looked at this bar and concluded things maybe from looking at the actual bars like this, but in a point and figure approach, this bar would have been the obvious breakout bar. Okay, so we're going to show you how this pencils out in terms of a point and figure chart that looks just like this. And that breakout arrow, I'm pointing at it right there. You can kind of see the blue one. That's where it signaled a huge, huge sell signal right there. And the beauty of point and figure charts, and these are used still quite a bit today, but they originated, these X's and O's that you see here, these really originated back in the, I'm going to say the late 1800s, really with the advent of the exchanges having floor traders who were speculating their own money in the markets while they were watching the intraday price go all over the place. All right, and I was talking to a guy, a friend of mine, that he was working the S&P pit starting in the early 80s. And he talked about these guys that still did this even into the 80s. Basically, they would work on filling orders. This is before electronic trading, okay? So if you can just picture this, these guys are on the floor. They have their own little account they're trading, but some of them, their primary business was filling orders for other brokers. And so let's say you had, a broker, gets a phone call from a client and he wants to put an order in. Fine. The runner then runs to the pit and gives the order to this floor trader, or they call them brokers as well, but he's the filling broker. And he works for several different brokers sometimes. He could work for multiple people. And he takes the order and puts it in his left hand. Okay? So as these and it might be an order that's triggered at a certain price. So to maybe go long 50 contracts if the price hits this particular place. So he then takes the order, slides it into the right spot amongst all these other papers in his left hand. And then what he does is he waits for the orders to get triggered. Okay, if it's a market order, he gets the order, he fills it, flashes it in, he gets it filled. If it's a limit order or an order that is triggered at a certain price, he puts it in the appropriate order in his hand, and so he's holding in his left hand this whole wad of papers that he's constantly, ordering. Now, this is the days before electronic. At the end of the day, these guys would have a big cramp in their left hand, from holding the papers. And so he's off filling orders and everything. Okay? Now, at the same time, he has his little account he's trading. What he does is he has a little index card in his front left pocket and a pen or a pencil, and he can just take that paper out and scribble on it, just a notation. And if let's say the price is going up that day for that stock or index, whatever pit he's in. If the stock is going up, every time the market might say go up, say 25 cents, 50 cents, just depending on how big the market is, he would draw a little X. All right, went up another 50 cents, write another X on the paper. Oh, went up another 50 cents, write another X. Oh, the market came down. Now he's writing O's as the market comes down. And in this way, he's kind of keeping track of the direction of price going up and down and up and down. So he's not really able to draw bar charts, and he's too busy to go look at a terminal to look at the price chart. So he's just simply scribbling X's as the price goes up, X is going up, and then if the market starts going down, he starts drawing a column of O's going down. And this is where the point and figure system started, was with these floor traders that were really busy filling orders, and then they needed a real simple way to trade breakouts. Now, if the X's went up and then the O's came down and then the X's went back up again, boom, he would be able to see a breakout. So that's where it started, and that's what I'm going to explain here as we go, and we're going to throw on a little options approach here to boot. Okay, so in this case of Apple, we have a real clear breakout here, and I'm going to explain how we actually draw these charts. Here is a current chart of Walmart. I'm using Metastock here to compose this. And again, I'm going to fully explain all this, but if you were to dial up Walmart in Metastock and convert it over to point and figure, this is what it would look like. Here is the same chart in Market Edge. You can go to marketedge.com and subscribe, and this is what their point and figure charts look like. All right, do I have another one? Here is Stock Charts. Stock Charts is, and you can go to stockcharts.com and get free point and figure charts right here, like you see this. So there are multiple sources. You could go online and do a little Google search and go find some good systems out there that give you point and figure charts. And here is, let's see. This is the scanning feature within stockcharts.com, and you could see they actually have some point and figure, a whole set of point and figure patterns that can give you, you could scan for these particular patterns. Today we're going to talk about the triple bottom breakout and the triple top breakout. Okay, now I think these are just simply the number of stocks currently operating on that signal. It doesn't show that they actually came out today with that breakout necessarily. Okay, so but I just wanted to point that out, that these tools are available to you online, and we're going to work into an options approach here. So here, what's going on here basically? How do we draw these things? Listen, it is not a time-related approach at all. Okay, you remember that floor trader? It might take an hour for him to have to draw an X going up the screen. If price just lays there for hours at the same price level and doesn't move much, it might take him a long time to draw another X going up. But here's the idea. We label the paper is laid out in a grid format where we have a little box here. And X's are always drawn going up. In other words, we would draw an X, and we won't draw another X until price ascends up a certain increment. Okay, so for a stock at $50, each box is going to be worth $1. So every time the stock goes up another buck, we paint another X going up the screen, another dollar. We paint it up, and in this case, we're always looking at the highs and lows of each bar. Okay, the highs and lows. When the high makes hits another dollar mark, we then post another X going up the screen. So X's are always drawn going up the grid paper. Okay, box size. All right, these are $1 a piece. And this company back in the I'm going to say they must have started in the 40s or 50s. It was called Chartcraft. Today it's called Investors Intelligence. They came out with this particular, I needed to move this thing over here, okay? Just need a little tab action here and here. Sorry about that. That's kind of weird how that happened. Basically, stocks that are priced between $20 and $100, each box is $1. Okay, 100 to 200, each box is worth $2. 200 to 500, we go to 5, and so forth. Now, when you get down into the stocks under $5, and then you go to quarters, each box is just worth 25 cents. So this is the Chartcraft approach. Now, there's other approaches. You have some sliding scale approaches where you try and get some extra accuracy. Each box can be a little bit different than the previous one, and you can build that in a computer, and it gets kind of complicated. But you should know that these are just the Chartcraft settings are what many of the programs do use. Market Edge uses that, and I also think, if I'm not mistaken, Stock Charts does as well. All right, so that's the box size. Okay, now decreasing prices, declining prices mean that we're going to go into a descending column of O's. So as price goes down $1, we draw an O coming down the screen, and every additional dollar that's hit, we draw a column of O's going down the screen. So X is going up, O is going down. Now, when do you switch over? When do you flop from column to column? This is called the three-point reversal approach. Column of X is going up, prices then decline 1, 2, 3, then we're going to draw a column of O's going down. They can keep going down a little bit. As soon as price reverses, at least $3 in this case, we now go up 3 X's. So the minimum number of X's or O's you must draw is always at a 3. We must always draw at least 3 X's or 3 O's when we flop over columns. Okay. Now, Richard Wyckoff, he has it down to like 1 or 2. And he'll vary it, okay? And he would actually keep multiple types of point and figure charts varying from 1 to 5-point reversals, okay? 5-point was a big, huge top of the mountain view of the market, a 5-point reversal. A 1-point reversal was much more active. You'd have a lot more columns that way. So, but the standard in any software you see will typically be 3-point reversal using the Chartcraft box size parameter. All right, so that's how you draw the column of X's and O's. How do you get signals? Okay, take a look at that. Let me get a sip of coffee here just a second. Yeah, I know, all day, every day with the coffee. Okay, a bullish alert occurs when a column of X's rises above the top of the previous column of X's. So here we have a column of X's going up, and when this final X here was drawn, we note that it surpassed this column of X's. That then becomes a buy signal. That is a bullish alert. It is a buy signal. Okay, now can you guess what a bearish alert would be? Real simple. It occurs when a column of O's declines below the bottom of the previous column of O's. So here we have a column of O's going down. Okay, and right when we get to this one, that signals a bearish alert because it decreased beyond, at least one box beyond the previous column of O's here. See that? So that was a sell signal. That was a very clear sell signal, a bearish alert there. Now, there are patterns. There are patterns that occur that you can, in some programs, they give you the ability to scan for these now, but these are clear breakout type signals. Okay? What I just showed you, these are double top and double bottom signals. Simply when it rises above the previous column, that is a double top. Going down below the previous column, that is a double bottom bearish alert. Double top bullish, double bottom bearish alert. Watch this. This is the one we're interested in here. Triple top and triple bottom signals. When you have two columns that are topping out at the same level, and then the third column goes above both of the two previous, that is a triple top breakout. All right, very reliable signal typically. Likewise down here, when you have one column coming down, the next column coming down and it stops at the same level there, and then the third time it breaks through like this and has a bearish breakout, a bearish alert after these two previous columns, that is a triple bottom breakout. And what's the market telling you there? It's telling you basically that it is going down past an established support level. An established support level. On the bullish breakout, it's breaking out above an established resistance level. Resistance was established once, twice, boom, 3 times a charge. It's off to the races on the upside. All right, now there's other patterns, and this is just one set of them, and that is catapult signals. And these are fairly reliable ones where you have a bullish breakout, and yet you have ascending columns of O's here. See that? How the previous column of O's did not go down as far as the previous one? Okay, that's called a catapult formation. Likewise, a bearish catapult is where you have a bear alert, but you have the X's, the column of X's, top out and are declining up here. You have a descending trend line, I guess you could call it right there. Okay, and that adds to the reliability of those particular breakouts. And again, you can scan, but there's a whole catalog of various types of breakout signals and what constitutes strong signals from weak signals and everything. Now, what are we going to do? I mean, there's various ways to do this. I'm going to show you one approach, just one. I'm going to show you why I was disappointed with some of the results and what the adventure we had there. And then I'm going to suggest an approach that we can test, and I'm going to test it leading up to my talk at the SIBO here in another week or two. All right, and that kind of reminded me I was going to get the exact date of that, and I wanted to give you the date and time. So let me dial that up here in my little iPad calendar. I'm going to get you. Yeah, it's on the 19th, a week from Wednesday, actually, at 3:30. I'm going to be talking about this exact same topic. Some of the charts will be the same. It's just that the actual system we use to trade might vary because of what I'm going to show you here, okay? But in any case, whether whatever signal we use, we're going to use credit spreads. That's the, if we're going to establish just a benchmark approach, we're going to use credit spreads in this case. Let's say that we get a triple top breakout right here. A triple top breakout. Let me switch colors here. Right here, triple top breakout, a buy signal. If we get a triple top breakout, what I'm going to propose is that we go ahead and just put on an at-the-money credit spread. Not an out-of-the-money bull put spread, none of that. We're going to go right at the money. We're going to sell the put strike, the at-the-money put strike, the one that has the most time premium. And then we're going to go out of the money to the next put strike and buy and create a pretty tight at-the-money credit spread. All right, and in the bearish sense, we would do the same only with the calls. All right, now, how do we get out of this? All right, if things work out, we're going to let it expire worthless. If the market does break out and go, we're just going to let it go and expire worthless, and we keep it. Now, of course, you know, I'll talk about a little bit about possible alternatives to that. But we're going to go ahead and let it go, and we're going to remove the spread basically when an opposite point and figure signal alert occurs. Okay, so let's just take an example, and this is in our, and I back tested, you know, this, you know, going from 2001 to 2008, and then from 2008 to the present in several stocks. But I want to show you an example here. Now here is, you know, Apple, and we're going to take a look at this little breakdown signal, this triple bottom breakout that occurred right there. Okay, so on the day that that occurred, all right, let me just show you. Do you see that breakout there? I'm going to take you to the bar chart and show you the bar chart switching back to the point and figure. You're going to have to kind of look carefully to see when it was that that breakout occurred, but we're looking right there. And here are the two charts kind of put next to each other. On the left, you have the bar chart. And there you have the market coming down and hitting the letter A. Then it swung up. Remember, we're looking at the highs and lows of each bar. And indeed, in this case, you know, Apple got really, really volatile. Every day it was moving around and making new columns, which is kind of unheard of for it to happen that often. But back in 08, this is what was going on, if you remember. Okay, so it went up and hit that point at B, went down and hit the point at C, declining just a little bit below point A there to create a column of O's. So that was a sell signal right there in and of itself. Then look what happened. Item D was made the next day, looking at the high of that bar. Then the next day it comes down to E. Now this is interesting. Look at this. In the bar chart, items C and E are not really right next to each other. The lows of those bars are not precisely right at the same level, where you could draw a trend line or you know, really a channel even. E is above C, but yet when you look at the point and figure chart, because we're, you know, pretty much rounding and going to the next box, if it hits it, we're then actually drawing in that latest item of E in the O's there, it actually matches up with C. And that's kind of the one thing that really is nice about point and figure, is we're just looking at, you know, we're rounding and we're making some distinct patterns and kind of removing some of the noise that you can see here. Now look what happens the very next day. It goes up and hits F, and again, this is very volatile relative to what it usually does. And then look what happens. The very next day at G, boom, that's where you have your breakout right here. Right, oops, timeout. There we go. Right here. That's the breakout at G. And on that close, on the day of that breakdown and the day of that close, or, you know, just before the market closes, we're going to go in and we're going to go into the calls. And we're going to sell the at-the-money call, first one with over 21 days, and then we're going to create a credit spread just like this. All right. Now we're not, I know there's earnings coming out here in about a week, and you want to obviously be aware of that. But here's what happened. You can kind of see the horizontal skew here, but here's how we would play this. Time premium is highest right there. We're doing this in the calls. Going to come to the next strike up and buy. And we create a credit spread this way. Hopefully the market will continue to go down, and this spread which brings us $2.35, and a credit, you know, would expire worthless here in about a month. And that's what it looks like. You can kind of see that relative to our requirement, we're making, you know, some pretty decent money there. Okay, it's an at-the-money credit spread, and we're going to hold on to this until we get a buy signal or until it expires. The other thing I said is that if you get down to the last day of trading and it's actually in the money, you're going to want to buy it back and not get a sign, basically. You do want to watch that if you're going to trade this way with the at-the-money credit spreads. Make sure that you just navigate your way through getting a sign. Watch the time premium on that short, so don't let it go too far where it's, you know, only at 5 cents or something, and then get a sign that, you know, you don't want to mess with that. So you know, get out at that point. So that's what happened, and you could see here that we got in here, and we were in it all the way till it expired. Now, what happened next? Okay, now this is another example. Let me see, is this another example? Yeah, here's one. Here's an example of an entry here in 08 where the market went through and we had a triple bottom breakout. And then do you see this bullish signal right there? Here, let me change colors here a little bit. Let me also get a pencil. I think that might help. So right here was the breakout on 2/6/08. The market went down and up and down, kind of chopped around here. And then eventually we did have this buy signal right here, and that would have gotten us out of this trade, oh, about, you know, three and a half weeks later or so. Okay, so that's an example of us getting, you know, having a loss occur right there. See that? Okay, by the way, if you go back in time, can you see, yeah, see if you can see how many other, there's 2 other triple bottom breakouts if you look back. Do you see those 2 other triple bottom breakouts? Here's one right here. Do you see the one previous to that? Right over here. Okay. Very good. In this case, this one we would have gotten in on the close right here, and we would have gotten out at the close right here for a loss. We would have lost about 1/3 of the amount we were trying to make in that particular case. There was not carry through there. Okay, oh, and here's the example of the loser. Started out like that, and then we ended up, you know, down about $900 right around here or so. Okay, which is less than what it is we were trying to make in that particular case. Okay, so here are the trading rules more specifically laid out for you. Let me get a sip here while you know, take a chance to read some of this. Little preview here, just to be honest, you know, we're trying to give our students, you know, we get the mentoring students that we get, folks are looking for systems that make money consistently. And we do teach quite a bit of the non-directional stuff. We do have several students, or many, I would say a good portion, that really like to trade directionally and are looking for edges in a directional sense. And so we offer a catalog of not potential, but, you know, systems like this that are tested. And we're trying to improve on them all the time. And this is one that was tested out really well. When I looked at it back, I developed this thing back in the mid-2000s, and then last reported it in 08, and then I wanted to update it and show you guys, and then also at the SIBO. But here are the rules that we're testing, just as a baseline test, and I already talked about this a little bit. Okay, on the close of the day that a triple top, oh gosh, where's my, there it is. On the close of the day that a triple top breakout occurs, we're going to do an at-the-money put credit spread. This is bullish. Okay, we're going to go to the first month with 21 calendar days remaining, or more than 21. We're going to remove it when we get an alert in the opposite direction. we're going to let it expire worthless. Or on the last trading day, if the short strike is in the money, we're going to remove it and not get assigned. Okay, so that's just the benchmark trading rules for us just to see if there's an edge here. We invert these rules for the bearish side, and I included a page there for you there to take a look at. And here's what I did to test this thing. And I tested this thing 7, 8, 9, 10, 11. This is about, I'm going to say, I should have wiped that out. It's about 12 years or so of testing. I took a look at 7 stocks, 7 different stocks. Now, I could have just taken the SPY, but one asset just doesn't give you enough. One asset just doesn't give you enough triple bottom, triple top breakouts to really give you a good data set there, a good population to see if there's a good edge or not. Okay, now I got to tell you, this thing we had before, we had about 27 trades through early of 08, and it was really doing awesome. There was about 65% winners. Okay, and what I'm going to do now is basically show you how this thing went. And I'm going to share with you my desktop. Let me go and do this. Share with you my desktop because, you know, I put together the results, and I had about 2 or 3 more Apple trades to do. And I'm going to just go to my, where's the point? PNF. PNF test. Okay, I imported these files. Here's the T-log. Okay, there's the T-log. Perfect. All right, so I think we're ready to go here. Let me click on Reports. Okay, and I'm looking at 1/1/2001. There we go. And again, I'm going to really refine the reporting of the results because I'm going to actually probably change the system a little bit. We're only looking at the viability of just trading one pattern, a triple bottom, triple top, going bullish or bearish. And I'm going all the way through today really on these. I go to performance analysis. Here's what you see, 59% winners. Okay, and don't mind the annualized return. This whole yellow section isn't really the most important thing. The most important thing in all this is going to be, let me get my annotation tool. Okay, the most important thing is going to be the number of winners to losers and the winning percentage. And you're going to want to study the average winning trade to the average losing trade. But I'm actually going to back out of this and even say, you know what, you really want to look at you know, something else. And that's going to be, let me get rid of this. What you're really going to want to look at is the gain and loss. And what I'll probably end up doing is copying this. Actually, if you're an OptionVue user, you can go to Print, and I'm going to print this to a file and open it up in Excel, and I'm going to calculate the yield, okay, based upon the gain and loss, okay, divided by the amount required to put the trade on, okay, which is the open cost and proceeds about. Is that right? Yeah. That would be the case, and we're going to then really, you know, check out, you know, how well the thing worked in terms of yield. That's the most important thing, is the average yield and the average, you know, the average yield on winning trades, and then the amount of the amount lost on the losing trades as a percentage of what it cost you to get in. You see, because here, a JNJ trade cost $2,100 to get into that 10-lot credit spread. Yet here in GE, okay, where you're only down at 17 and a half, you know, it only costs you, you know, $980 to get into that trade. No, 510. Okay, so is that right? I want to make sure I don't know that I'm reading this right. The amount required to get into the trade, open cost. See, this is the credit, and that's just not right. I'm going to have to create a spreadsheet and get into the amount required to get in and calculate the required margin differently. Anyway, that's more important because you just can't compare the profit. The gain and loss, you have such differing prices, you can't really do it that way. I hope you see what I'm saying. Maybe I didn't express that well. So anyway, that's where we're at. And, I think if I were to dial this thing back to, say, March 1st of 2008, you can see that we have a much better situation. 63% winners. The average winner was higher than the average loser. You see that? So what we're seeing is that over the last 5 years, there's been some whipsawing going on. The triple bottom, there's been some fake outs on the triple bottom and triple top breakouts that have resulted in some losses over the last 5 years. This approach worked better for the 7 years leading up to mid-08 than it has for the time from 08 to the present. That's what I'm saying. Okay, so I think I showed you that. That said, let me show you a way of trading point and figure that I think might be a bit better here just to understand. So let me go into this. I'm in stockcharts.com right now. Let me switch to the point and figure chart. Perfect. And can I blow this up at all? Let me see. Can I just copy this image? I don't know that you can see that particularly well. Let me come down here. Let me come right here, paste here. There we go. I'm hoping you can see that really, really well now. Hopefully you can see that a little better. Okay. So here's what happens. Over here on the left, and let me start annotating this. Here is one system of trading this long-term as an investor I think you may want to pay a little attention to. Okay? And so when the market is over here on the left, now where's my annotation? Okay, good. Over here, the market is going down. It then comes up and crosses above this bearish trend line. When it crosses the bearish trend line, we are now long-term bullish. And we take any signal that's firing above that bearish trend line there. In this case, in this particular case, really we could have, there's a strong case for having gone long right there at the beginning, right with that breakout. That breakout occurred above the bearish trend line, and it was a bullish alert all at the same time. That was a good reason to go long. We're above this bullish trend line, which we go to the most recent low and draw at a 45-degree angle. So we're long there, and we're long until we have a sell signal, which occurs right here. Okay, now that took a couple months. We were in that for quite a while, and we had a small gain there. We're above the bullish trend line, so we're long-term bullish, and we're only going to trade bullish breakouts. Double, triple, catapults, whatever. It doesn't matter. If we have a bullish breakout, we're going to trade that. And so now, market comes down, scrapes along the trend line, doesn't go through it though. By the way, it has to go through a full, it has to go through a full box before we then would have gone bearish, but it never did make that. We wait until January of this next year, and we're now long. And we're long until we get a sell signal. And we're long because we're above the trend line. So we're always trading above the bullish trend line long, and we're trading beneath the bearish trend line when we go short. All right, and that'll just a little bit here. Okay, so we're long there, and we're long until we get a bearish signal. And that happens where? Right here. Then we get out. That took, look at that, that took all of January, February, March, April into May. We were long, and we made some profit here. We gave some of it up here, though, but we were long all the way until mid-May or so. This is back in 2012. So we made money there. Now, we're out of the market completely until we get a buy signal, assuming it occurs above this trend line. If the market had gone down beneath the trend line, we would have waited for another sell signal to then go short beneath the trend line. But it didn't happen. Okay? So, we're waiting for the next long signal. Where did that occur? Right here. We're long, and we're long until we get a sell signal. When did we get a sell signal? Way over here. That's the next sell signal. So we made money there as well, and we were long this. We were long the market. And by the way, you could trade this same way with stocks, futures, anything. But we were long. That was mid-June. Let's see, July, August, September, October. That was ended October here, that we were long this entire time. And if we were doing this in a stock and we had the same pattern, we would have been perhaps doing covered calls, whatever. We would have been doing long type strategies, you know, rolling type long strategies, like rolling covered calls, modulating calls, covered call writing, something like that. But anyway, we're short here. Now watch this. We're out of the market until we get the next buy signal. The market, however, goes down beneath this trend line, and now we become bearish. And we're going to take any sell signal that occurs from this point forward until the market goes above this bearish trend line that we draw from the most recent high. Well, the market does not generate a sell signal underneath this. Instead, it blasts off, and once again, it creates a bullish alert that occurs above this trend line. So it not only creates a bullish alert, that bullish alert occurs above the bearish trend line. So now we flop to being bullish again, and we're taking every long signal that occurs while we're bullish, and there's our first one right there. We're bullish and we're in, and we're in until we get the next sell signal that occurs up here, beginning of June, beginning of this month. So we had, we were doing long strategies right there. So what you see is a system here that really bleeds out, that gets rid of a lot of the goofy noise, and you're just not paying attention to the daily noise. You're looking at these charts here and taking the signals. Now here we're short, and we're waiting for the next long signal, right? We're waiting for the next long signal. Unless the market goes down beneath this trend line, we're long, we're bullish, and we're looking for the next breakout to the upside, the next bullish signal to get in. And if this little column of X's keeps going up and breaks out above it right there, well, then we're going to be in at that point bullish. And we're in bullish until we get a sell signal at that point. So it's in this approach where you're trading with the flow of the trend line that I think I'm going to compose a system that we can report to on the SIBO presentation next week. Perhaps I'll also show the triple bottom, triple top, just straight patterns. But I think this kind of trend trading with the trend lines makes a good bit of sense as well. Okay? All right, so let me see. Let me go back. There's that. Let me go back here. And what else did we have for you? Here are some general observations. Just trading triple bottom and top breakouts, you're not going to get too many signals per year in any given stock, index, or future. Okay? And a few stocks had some pretty good whipsaws. Apple's one of them. Whipsawed pretty good here over the last 5 years when you did get those. There were some congestion points and some fake outs. There's some good scanners on the market looking for these triple bottoms, triple tops. At the money credit spreads, that's a good spread that you can use. You can also consider using out-of-the-money butters or calendars, butterflies or calendar spreads as well. Alternative exit approaches. You could do a yield grab, okay, where right now instead of letting it go until it expires, well, of course, if you're collecting a credit of, say, $600, okay, at Discover Options, one of our little rules that we like is that you would remove their spread when you can gobble up 2/3 of that, or $400. So as soon as you can claim your profit of $400, take the money off the table, leave the $200 there, okay, and don't get greedy. Take 2/3 of that credit when it's profitable and you can do so. It's like wringing a washcloth 3 times, you know. Once is easy, twice you get more. That third time, that last $200 is going to be the toughest $200 you'll make typically. All right, you have a bunch of time and you're only getting 1/3 of the total potential profit at the end. You know, just, you know, wring the washcloth twice and call it a day. Okay, you can also have a tighter trailing stop, perhaps, maybe 3 average true ranges or something like that. Instead of waiting for the next signal to fire, have a bit of a tighter stop would be another consideration to kind of blend in with these signals here that you see. All right, and that is it. Any questions? Again, I'm going to be speaking at the CBOE, all right? I should have just had this in a more formal deal. CBOE, that's going to be Wednesday, a week from this Wednesday. Okay, that'll be on the 19th. That'll be on 6/19 at the CBOE. You can go to cboe.com. You're going to have to register for an account, my CBOE account, and then it's going to be at 3:30 Central. CST. All right, and that'll be on point and figure, and we're going to throw in a different system there, I think, to complement the pure pattern adherence. Okay, no questions, comments? Perfect. Folks, I wanted to make sure once again, if you have any questions about our Discover Options mentoring program, okay, make sure you give us a call, take a look at our curriculum, go to discoveroptions.com, take a look around. Look, we just changed the website a little bit. We added in some great offers. If you haven't already taken the 3 free courses, please sign up to do so. We also have a free consultation you can sign up for with one of the folks here in the office, and we'll be glad to show you our curriculum and try and piece together what it is that's going to match you where you're at and where you want to go. Okay, folks, thanks a lot. Until next time, take care. We'll see you later. Bye-bye.